Hi there, everyone. Good afternoon. I'm Nancy McClernon, President and CEO of the Global Business Alliance. Welcome to our quarterly Economic Advisory Council that we do with our friends over at the Institute of International Bankers and Beth Zork. Really pleased to have everyone here this afternoon on a Friday afternoon to hear about some analysis on what's happening in the economy now and what can we expect in the coming months. I think we've got a lot of GBA members and IIB members on the program this afternoon. But for those of you who aren't already aware, the Global Business Alliance is a trade association. We're based in Washington, D.C. We're an advocacy group. We represent about approximately 200 international companies in the United States across a very wide variety of sectors. Our members come from every corner of the economy. We have a constituent relationship with every member of Congress. And our members come from 22 different countries. Again, for those of you who are not already aware, foreign investment in the United States employs about 8 million US workers, a lot in the manufacturing space, but of course, we've got many in the services space and the financial services space, which is why that we're so pleased to be doing these quarterly briefings with IIB. And so with that, Beth, I'm going to go ahead and turn it over to you to introduce our speaker today. Look forward to hearing all about it. Over to you.
Great. Thank you so much, Nancy. I appreciate that wonderful introduction. I'm Beth Zork, CEO of the Institute of International Bankers, or IIB. For those of you who don't know us, the Institute of International Bankers represents the U.S. operations of internationally headquartered financial institutions. Our mission is to ensure that U.S. banking laws and regulations are applied fairly to internationally headquartered financial institutions so our members can compete on a level playing field with domestically headquartered firms. This is critically important because our members inject billions of dollars each year into state and local economies across the country and through direct employment, capital expenditures, and other investments. Turning to today's program, I'm excited to introduce an IIB member to you, Joe Lavorgna, who is Chief U.S. Economist at SMBC. Before joining SMBC in 2022, Joe was Chief Economist for the Americas at Natixis, where he oversaw the firm's economic research and managed a team of economists. He also served at the White House as Special Assistant to the President and Chief Economist of the National Economic Council. Previously, Joe held positions at Deutsche Bank Securities, UBS Securities, and the Federal Reserve Bank of New York. Now, I'd like to turn the virtual floor over to you, Joe.
Okay, no wonder why. Okay, everybody can hear me fine? Great. Okay, thank you. So I've got a presentation, and I'm going to go through it quickly because I want to keep this interactive. And if people have any questions, they can ask me whatever they want. I mean, literally, nothing is out of bounds. I just may not answer your question. I always reserve that right, but I like to keep this informative, and I'm assuming you're going to have some questions because we're at a really interesting time. Rainbows, unicorns, and soft landings. I hope that you think there might be a little bit of sarcasm there. The world has bought into the soft landing narrative that the economy is going to be great. Everything's going to be perfect. Fed's going to engineer it. Inflation's going to come down. Interest rates are going to come down. Credit spreads are going to continue to tighten. The unemployment rate's going to stay low. And of course, the equity market, which is forward-looking, is going to zoom. And in fact, it has. The equity market, since it's low, this is a great stat. Since it's low, the equity market is up about 84% at an annualized rate. So if we go to October at this rate, the market will be up over 80%. Pretty incredible. Anyway, so let me just start by saying I am a bit skeptical of the soft landing scenario, and I don't think the economy is as strong as people think. That does make me maybe a bit of a Debbie Downer, but I'm not always a pessimist. I just don't think the economy is as robust as people think it is. If the economy turns out to be better, then the Federal Reserve certainly has to start cutting rates quite soon. Anyway, having said that, let me give you the 5 key points. So one, obviously I doubt the the soft landing scenario, and it comes to these reasons why. So number one, I believe that, and I'll show you that the labor market is overstating job growth. I believe that monetary policy is tight. The probability of a soft landing has increased to the extent that, we've been waiting for this hard landing for a while. It hasn't happened. And then one has to question whether maybe the economy could dodge it. Some of the imbalances in the system get worked out. But I still think that is still a very real possibility. I put the odds of a recession at slightly above 50%. One of the reasons we haven't had a recession is partly because of what I'd say is excessive government spending, and we could talk a little bit about that. And lastly, I do believe the Treasury market will eventually potentially steepen, meaning the short rate and the long rate will diverge. We've had this incredible phenomenon where the Treasury market, the biggest, most liquid, deepest market in the world, has been flashing recession for a while, and yet it hasn't come to pass. And at some point, though, that curve will need to normalize. And it may normalize in a way people don't think, with short rates coming down and longer term rates actually rising, which could eventually have some pressure on the business financing side. So anyway, those are the key points. Let me just go through quickly some of these charts to sort of tell you why I don't think the labor market is as robust as it appears. You'll see on the first slide that the factory. Oh, sorry. You see on the first side, this quarterly census of employment and wages. Those are detailed data that are released quarterly from the Census Department that measure the amount of jobs based on unemployment tax filing. So, for example, if you look at your paycheck each week for W-2 workers, you're going to see money that you pay into the unemployment insurance fund so that, heaven forbid, you were laid off, you're going to get that money back through unemployment insurance. The payroll data, which people look at every month, it's front page news. You read about it if you see it on the weekend papers or on your news feeds. Those payroll numbers, according to this chart, are overstated, by about 900,000. In other words, the government data is showing more jobs than what the benchmarked or tax filing data show. So that's one factor. You see the next chart, we go to the next page, that if you look at the household survey, which is where the unemployment rate derives, those numbers, and these are buried in the tables of the BLS report. SMBC and other firms have their economists that are able to go through all these nitty-gritty minutia, the data that save people from getting a migraine looking at it themselves. But you could see from that slide that the household private employment, which is where the unemployment rate derives, has been running substantially below the payroll data. So you've got one measure that looks at tax receipts. That's saying employment is overstated. If you look at the household survey, which is a corollary to the payroll data, that suggests that payrolls are being overstated. Next chart, please. And when we look at things like temporary hiring, in other words, staffing firms that are looking to staff people, we see this tremendous divergence between what temporary hiring is doing and what the overall level of employment is doing. So we have this situation where I believe the job numbers aren't as good as what we're being told. At the same time, leading indicators of the economy like temps, because you hire a temp, and if you like that temp, you make that temp a full-time worker. When temp hiring goes down, it's going down quite significantly. Generally, it's just a matter of time before the overall labor dynamic changes. Next slide, please. And in fact, if you look at small businesses, which are the dominant employer of people, they're about 45%, and the rest is split between large and medium firms, small firms being under 50 people. You could see that small businesses, the National Federation of Independent Business, the NFIB, they are showing that their hiring intentions now are the lowest since 2016. I'm squinting as I have to lean forward to look at it on my camera. So we're the lowest amount of hiring since 2016. So right now, I mean, it seems to me when I look at these data, the labor market's not as great as what you're going to pick up in the paper and read about how these jobs are so robust and things are chugging along. Next slide, please. And you see this in other reports like the factory work week. The factory work is a leading indicator of the economy. Manufacturing is a very cyclical part of the economy. the Institute of Supply Management covers the manufacturing sector. Those numbers as well show that hours are declining and employment within the manufacturing sector is slowing. So if you have temporary hiring that's soft, actually, I shouldn't say soft, it's declining. You've got employment within manufacturing appearing to slow. At the same time, the work week is shrinking because if you don't want to get rid of people initially, you want to hold on, you want to see how demand is. You cut hours, and of course, you can't cut hours enough. You have to actually, unfortunately, let people go. So again, this is coming against the backdrop, I'd argue, of jobs being overstated. I would say this is not the healthiest of labor markets, even though you're going to read in the papers otherwise. If you go to the next slide, we can see that if we look now at interest rates, we know interest rates are incredibly high because if we go to homeowners are saying right now is one of the worst times to buy ever. You're basically back to levels last seen in 1981, 1982. Then the prime rate was up over 20%. The Fed was fighting double-digit inflation. It jacked rates up, and clearly there were very difficult people to buy a home. Right now, they're basically saying the same thing. It's hard to buy a home. And the reason this matters, if you go to the next slide, is you're going to see that home activity, because it's such a difficult buying environment for homes, that's collapsed, yet residential construction employment keeps going up. So you've got essentially a housing market that's more or less frozen because rates are high, reflected in the fact that homeowners do not think it's a good time to buy. They've got very little affordability, and yet employment continues to rise. If we were to close that gap in that chart, that's worth about 1 million workers. We could see from the next slide that building permits, which are a leading indicator, they have been quite soft. And again, too, there's a large gap between construction employment and permits. And we are assuming that gap will eventually close unless, of course, Fed starts cutting rates and cutting rates aggressively. So just to recap to this point, I said at the very outset, I generally don't believe in soft landings. They're far and few between. Similar, you'd argue, maybe to rainbows and unicorns, of course, we know are fake. At least I think they are. And so we've got this soft landing narrative, and that's up against what we think are employment gains that aren't as robust as what people think. And it looks like, based on what's happening in the housing market, we're overstaffed by a significant amount of people, upwards of 1 million folks. If you lose 1 million jobs in the construction industry, that by itself could push the unemployment rate up close to 3/4 of a point. So what happens in housing, what happens in rates is very important because that could feed back, obviously, into the labor market and have negative implications throughout the rest of the economy. The next slide, please. This is the average time to complete a home. So when somebody says, why is it we haven't, you see it's been going up. In fact, that chart is, you have to go back to even earlier period to find a similar time where it was this high. It's basically at a record. It's taking longer to complete homes. And I think what's happened is builders, hoping that rates will come down, have stretched out the amount of time it's taken them to complete work because they don't want to lose many skilled workers that were very hard to get for a variety of reasons. Initially, the pandemic, where activity was impacted by both supply disruptions and health guidance and things of that sort that didn't allow people to transact, obviously, as easy as it was pre-pandemic. So it was difficult to get work done. And then, of course, rates had collapsed. So mortgage rates were under 3%. The housing market was booming. All that is now cooled as rates have gone up significantly. And firms, I think, are very hesitant to let some of these hard-earned and hard-fought people to let those folks go. And you're seeing it in the time to complete a home. So what it means to me is that these lags from rates and monetary policy changes to the economy, especially housing, may have elongated a lot more than people think. And that could be a reason to this point why you haven't seen those construction job losses. Next slide, please. We know rates have gone up quite dramatically, and you can see here that the Fed has raised rates in this cycle more and as fast than they have at any other previous time going back to the early 1980s. So the Fed has raised rates a lot, a significant amount, and we do think eventually that's going to have some effects on the economy against the labor backdrop, as I said, again, not necessarily as healthy and robust as the official numbers show. And again, where will we see the job loss? We would see the job loss starting to occur, if it does, in the residential construction sector. Next slide, please. The increase in interest rates has pushed up the real Fed funds rate, or the inflation-adjusted funds rate, to a range between 2.5% to 3%. And to me, what's very interesting is if you look at where the real Fed funds rate is now, it's the highest it's been at since 2007. And interestingly, the equity performance over the past 12 months has also been somewhat similar. We're up about 23, 24%, slightly less than that in June of 2007. For what it's worth, the economy peaked in December of 07 and was in recession in July of 07. So these high real interest rates, we think eventually will bite and restrict economic activity. We've had tremendous equity performance. The equity performance has been based on the concept of a soft landing, everything working out very smoothly. That may be the case, but just keep in mind, we've had other periods that were similar to this, and they didn't necessarily end well. So again, I think much will depend on what the Fed does, and the Fed having to lower interest rates certainly will help and increase the probability that a soft landing occurs and a recession can and ultimately be avoided. Next slide, please. That big increase in real Fed funds, Fed funds rates between 2.5% to 3%, depending how you measure it. The big increase in the federal funds rate I showed you, biggest since the early 80s, has caused household borrowing rates to rise to their highest level since 2001. So for a U.S. household that's looking to borrow money, they've not paid this high an interest rate in over 2 decades. So we could be real happy with how equities are performing, and financial conditions for investors have eased dramatically, and that may help steady the economy and keep it from tipping over. But for many households, those borrowing costs really have been quite significant. Next slide, please. This shows now household non-mortgage interest payments as a share of disposable income. And you could see that we're up at levels in the past that have the economy's either been in recession, such as 2008, 2009, or close to a recession, such as 2001. So the big lift in the funds rate, which has increased household borrowing costs, is having an effect. It is dampening consumers' ability to spend. Next slide. And that's why you're starting to see retail sales now, year-on-year growth in retail sales is just around 2%. So we're watching this very closely to see if this trend continues. Obviously, if retail sales fall another couple points and we're near zero, that would be a sign that the economy is meaningfully slowing down, because the consumer is 70% of expenditures-based GDP. Next slide, please. On inflation, I just want to talk a little bit about inflation. We're generally of the view that inflation will come down because leading indicators of inflation, such as the producer price index, which measures wholesale prices, you see that has tracked the CPI very well. And the PPI has come down quite significantly. It's around 2%. Core CPI might be around 4%, but we think that core CPI is going to come down and follow that PPI lower, because you'll see on the next slide. Next one, please. Sorry, I'm not going to talk about that one. Okay. The reason that core CPI is going to come down is because rents, which are about a third of the core CPI, rents are going to collapse based on what's happening with new tenant rental signings. They're down almost 5% year on year. And you could see how closely these two series track one another. So if we go from roughly a 6% rate on your 6% rate on your rents down to about a 3% rate, that's going to take 1 full percentage point off of your core CPI. So you'll be going from something high threes down below 3%. And if you go to the next slide, one more. No, darn, may not have it in this one. Anyway, what I was going to say is we can leave the slide here. What I was going to say is that if you look at goods prices, commodity prices, import prices from China, those are also weakening. So between your rents and your goods prices, I think there's a very good chance that your inflation rate by the end of the year is going to be down near 2%. In fact, if you don't mind, go back to that slide. I skipped over the other one. Go back if you don't mind, just for a minute. One more, please. One more. Great. Thanks so much. So this is kind of a tricky chart, but so just bear with me for 1 second. People talk about residual seasonality, meaning the inflation data tend to do wacky things at the beginning of the year for reasons that aren't entirely clear, but one of which is maybe that the government's not seasonally adjusting the numbers. So if you look at the raw numbers, you'll see that January, look at those data points, they tend to be a lot higher than they are the rest of the year. And we've seen the last few years, January and even February print really big gains, but then they moderate. So just, I guess that was a chart maybe I shouldn't have skipped over, but we think this early year inflation will eventually dissipate. If you don't mind, just go ahead forward to the Treasury curve, the 2s, 10s curve I showed, and I'm almost going to wrap up for questions. Okay, great. So I mentioned the 2s, 10s curve, and we're at levels right now that have last been seen basically since the early 80s, and now that when the month of March is complete, we'll break a new record. We'll be 22 months curve inversion, which has never happened before. So it's very unusual to have this degree of yield curve inversion with the short rate, the 2-year note, above the 10-year note for this long. And this always has been a great recession gauge, but so far in this cycle, it hasn't worked. If you go to the next slide, you can see the same thing with the index leading indicators, which the other day printed its first positive reading. Now, they may get revised down, but it printed its first positive reading in 23 months. And you can see the index leading indicators is also sharply negative. And normally when that is falling in negative, the Fed is cutting rates, and yet the Fed has yet to cut rates. Clearly, we haven't had a recession yet, and yet this index is saying we should have had one. So again, makes the environment, to me, perhaps a little bit more cautious than what maybe many think right now. People have kind of maybe gotten caught up in the equity exuberance per se. Next chart. The unemployment rate in the past, every time it's gone up 50 basis points, every time, and right now it's up 50 basis points, we've always had a recession. Those troughs or those low points in the unemployment rate are shown by the curves. When we've gone up 50 basis points, you've always had a recession. We're up 50 basis points. So again, that as well is telling us, along with the yield curve, along with the index of leading indicators, along with the temporary hiring I showed at the outset or earlier on, also kind of suggesting a downturn. Next slide, please. One of the reasons we haven't had a downturn is we've had tremendous government spending. If we were to take the amount of spending from 2021 to present, we are running about 3.2 trillion above the pre-pandemic trend. So, and according to CBO, outlays as a share of GDP are expected to remain very high, historically high, which is why budget deficits are high right now, despite the fact that unemployment's low. And even though the deficit is supposed to shrink according to the CBO's estimates, you're still looking basically at a 5% budget deficit in perpetuity. And that's without a recession and with unemployment low. If you have a recession, that budget deficit, the GDP ratio is going to go up at least several points, perhaps more. And that could be a problem because if the government needs to stimulate or help out the economy, it may not be able to do so if interest rates rise because they're fearful that the deficits are just even that much larger. Next slide, please. So one of the other reasons this is very important, this might be the most important reason why we haven't had a recession, and I believe this is the last slide. Corporates have not faced higher interest rates. They've actually seen their interest expense go down. And the reason for that is many companies locked in low rates in 2020, 2021, early 22. So when the Fed raised rates, they didn't suffer. At the same time, with the Fed having lifted rates so much and with the yield curve inverting, companies are making money on carry of their cash accounts or their treasury accounts, their institutional money market accounts. So that's an unprecedented dynamic, which makes things really interesting. At some point, as the maturity wall matures, as the wall of debt matures, we do expect those corporate interest payments to go up. But we think this is a reason why you may not have seen that hit to the economy that so many of these leading indicators have suggested. So anyway, I'll leave it there. I spoke for about 25 minutes. I want to do a little bit less because I want to save time for questions, but thank you. And I'll turn it back to you guys.
Great. Thank you so much for that, Joe. It was really wonderful. While I'm waiting for the questions to be sent to me, I thought I'd start with a few based on some of your remarks, which were great. So you obviously walked through a couple of different data points. What do you think are the most critical data points that the Fed should be considering as it's setting monetary policy? Do you think that the Fed, say, overweights or underweights any data points? And what's your view on maybe the impact of housing statistics and other time-delayed metrics?
So on the Fed, the Fed is focused on inflation. So it's obviously a lagging indicator. It'll be hard for the Fed to cut interest rates if core inflation, core consumer prices, the core personal expenditures deflator, so the core CPI and the core PCE, we need to see 0.2s on a monthly basis for at least several more months, 2 or 3 more months. That's what they're going to need if they want to cut interest rates in June, which is what the market's expecting. In other words, they're going to need to see inflation print basically 0.2, maybe even a shade less. If it doesn't happen, the only way they would then cut would be if the unemployment rate rises further and you see more noticeable slowing in the payroll data. The payroll data looked great last month, 275,000 increase. We had a nearly 170,000 downward revision. If over the next few months, job growth slows more noticeably, and we're running only around 125,000 a month, and the unemployment rate edges up from 3.9 to 4.0 or 4.1, then I can see the Fed cutting. So I focus on the core PCE, core CPI, those inflation metrics, the unemployment rate, and is payroll growth, even though it might be overstated, is the trend slowing. On the housing side, I don't think there's going to be much improvement in housing because, again, mortgage rates are still up near 7%. They need to come down. And I think for that to happen, the Fed's got to start cutting. And even if they cut, those mortgage rates may not come down if the bond market's worried that the Fed cutting could keep inflation higher than it's supposed to be, which is why that yield curve steepens in a way that may actually hurt housing, where short rates are down, but long rates are up.
Great. Yeah, makes sense. We all obviously watched with bated breath for the remarks that Chair Powell gave earlier this week. And I was just curious, what surprised you the most about his remarks? And, I think what I've been seeing, and again, would welcome your thoughts here. I think some are expecting maybe 3 cuts this year. And do you agree with that? And when do you think they might start?
I mean, 3 certainly is a good number. I wouldn't go less than 3. I'd probably err on the side of maybe 100, maybe even more. I just know from doing this a long time that when the economy breaks, it breaks quickly. Although I feel like trying to guess when the economy breaks is a little bit like picking the bottom in the market. It's almost impossible to do. But I certainly think, as I laid out, there are some cyclical weaknesses in the economy, so that things could change quickly. But I think 3 for certain, starting in June. Nothing Chair Powell has said to me recently is surprising. I mean, I was a bit surprised, to say the least, when they pivoted to the possible easing in December. I mean, I'd been arguing for rate cuts for a lot of reasons, but I didn't expect Powell to do it. And I do think the election is an issue. I wish the Fed had operated under a Greenspan approach where it didn't try to be so transparent. Not that transparency isn't a good thing, it generally is, but I think with monetary policy, you don't really know the economy that well. You don't really, hard to forecast things. Central banks should have more optionality, and now with them telling you all the time what they want to do is a bit of a problem. And I think that, the election's coming up. The Fed's very clear in its intentions. It can't hide behind open market operations like it did decades ago, which I think sometimes could have been an advantage. So if the Fed's going to not cut in June, can they cut in July in between the 2 conventions? It's going to be hard. So I think the surprise was when Jay Powell switched in December, then goes on 60 Minutes in February, lays the case for rate cuts, repeats the dovishness again in March, So I think he's, and I, by the way, am for rate cuts, but I think he's laying the groundwork to try to protect himself from the inevitable politics that will come if he doesn't cut rates this year or if he does cut rates this year. But nothing surprised me this past week.
Great. And you touched on this a little bit, but I wanted to kind of dig into it more. What do you believe will be the near-term and long-term consequences of the Fed continuing to unwind the $7 trillion it has in government bond holdings?
So the interesting thing is that we kind of knew it was going to happen because Powell told us this back in January, but he said the Fed is going to fairly soon consider stopping QT, and that may come. My guess is they will. Well, they might do it in May. I'm kind of agnostic on if they announce they're going to. Well, I think when they get to the May 1st FOMC meeting, they may say at that point, because it was 2 years ago when they said they were going to do the QT, that they're going to slow the pace of the QT. It'll start in June. As I think about this, that makes sense. If they get to the May 1st meeting, they will say that they are going to slow the pace of QT beginning in June. That's the month they also begin the rate cuts. And then by the end of the year, QT will stop, and they'll still have a balance sheet of around 7 trillion treasuries.
Great. I'm sure you saw the CBO report that they released last month, where they said spending on interest to service the national debt will likely exceed federal spending on defense this year. How do you think that's going to impact the economy?
I don't think it's going to impact the economy other than the fact that when you have rates that are so high and they went up so aggressively, like my chart showed, this is the fastest hiking cycle since the early 80s, your interest costs on the debt are going to go up, especially when you finance a sizable portion of the debt in the front end. So like in the last 12 months, the Treasury has, almost 80% of its net issuance has been in bills. And the general average maturity of the debt's been shrinking. So it kind of makes sense if you raise rates really quickly and you're bringing all your supply to the front end, you're going to get the interest expense on the debt as being your fastest rising line item. So that doesn't surprise me. Of course, if the Fed cuts rates and if the economy is weaker, allowing rates to come down more than people expect, you're not going to see that interest expense rise at its current rate. It will slow quite dramatically.
What do you believe? Obviously we represent your bank and so many other international banks as well. And so I'm just curious about international factors, how you see maybe trade tensions, geopolitical challenges, and global economic conditions as impacting the U.S. economy.
Okay, so a couple of things. Just on Trump, I would say under a second Trump administration, the former president certainly will push very hard on tariffs as the point of negotiation. He is going to try to make the Tax Cuts and Jobs Act, or TICJA, which is a horrible sounding term, but when you hear it in the press, you'll now know what it is if they say it, make that permanent, and certainly try to deregulate more and then do more shale and energy and gas exploration. Basically kind of like a 2.0 on the economic policy that was put in place in 2017 with deregulation, more energy output, and then trying to onshore more work from overseas. That's why one of the reasons why they want to make the tax cut permanent. I don't know if that's going to happen because the people I talk to right now suggest that given the redistricting, there is probably a better than 50% chance that the Republicans do not hold the House. They lose the House. They may hold the Senate, but with the House in the Democrats' hand, a lot of legislation won't get done. So I think you will see a lot of executive orders as it relates to energy. So I think that I highlight this only because there's a difference between the Trump and the Biden administrations, and I think on the energy side that might be to me the most obvious place. On the financial regulatory side, what's interesting is if you've seen a lot of the comments in the press recently about the Basel Endgame, there's been a big push by the GSIBs and many super regional banks that want to dial back the regulation that is on a lot of these big banks are going to suffer if Basel is implemented the way it's supposed to. And I believe now it's supposed to be sometime in mid-2025. And that's happening already. So I think, that's something that might continue. I don't know how that's going to play out. The Fed has been a little bit less bank friendly than in the past. but I think they're cognizant of the fact that you don't want to put U.S. financial firms, which are the most innovative, dynamic in the world, at a disadvantage. And this is, by the way, coming from all the big banks who remain nameless, but you clearly know who they are. You don't want to level the playing field by burdening U.S. financial firms, and so that they're on par with their European competitors in a way that they don't feel like they could make as much credit and loan creation, et cetera, for the economy. So I think that's kind of interesting, and that's where Biden and another Trump administration will probably line up. Certainly, President Trump would push in that direction, but I think the Biden folks might as well. On the geopolitics, all the spots. I do think China is still an issue with respect to Taiwan. No, I don't know when those tensions could potentially flare up again. North Korea is a bad actor. Middle East is always a perpetual powder keg of uncertainty and tension. Obviously, the situation in Israel and Gaza is not getting better. That's sort of the known known unknowns. But as we learned with the pandemic, there's always these other shocks and things that could ripple through the system. And maybe, if something happens nobody's expecting, maybe that's the catalyst to push the economy over, because right now the equity market is lifting consumer and household confidence, household and business confidence, and everything becomes endogenous. Like positive sentiment feeds upon positive sentiment. Companies don't lay workers off. They get more optimistic, and you get this self-feeding, cycle in animal spirits, if you will. So the geopolitics are very fascinating. But I feel like whenever that, almost by definition, a surprise is a surprise. I don't know what that's going to be. I really don't know. But I do think that, that whatever one's views are of November 2025, it's very well could be divided government. If Biden wins re-election and the Republicans lose the House, they may hold the Senate. So I just think, we might be working ourselves up into thinking that what could change in a big way relative to your politics may not change, just may be more of the same, which I don't know if that's good or bad.
So I don't think we can have a conversation in 2024 without bringing you back to AI. So in your mind, how will AI impact productivity and employment?
So on the productivity side, it's interesting, without going into a whole lot of detail, there's reasons to suggest that productivity might be overstated. I think AI is a neat concept. I actually think that the internet was more revolutionary than AI. I'm not a Luddite, but I don't think AI is going to have. I think AI is much more zero sum than people make it out to be. And clearly, you've seen a few companies that right now look like the clear winners. The problem, of course, with technology is somebody invents and invents something better. It could displace technology very quickly. I remember the BlackBerry, which people were on that all the time. And that old device, I'm not sure even exists in any form. That maybe it does, but technology is a way of changing. But I think AI, if you're looking at replacing people, and some of which these people might be replaced, whether it's accountants or first-year law students, or the technology allowing you to replace generally white-collared skilled workers, that to me is kind of deflationary. And what are those people going to do to find jobs elsewhere? So I think it's a neat thing, but I don't necessarily think it's going to be this revolutionary game changer everybody thinks it is. But we'll see.
That's great. And the last question I think we have is, are there any specific sectors or industries that you believe are particularly vulnerable or resilient in the current economic environment?
The manufacturing and housing sectors, to me, are the most at risk, because they've been the most cyclical. They've been the weakest, and the reason, maybe, as I said, they're not having the job layoffs is because of the expectation that interest rates fall dramatically. I think that we're in a world probably where rates aren't going back to zero anytime soon, and over time, if the yield curve steepens and you get higher long-term rates relative to what had been the case the last 15 years, that's probably going to favor more value-oriented companies, because what we've seen for the last several decades has been a very powerful thrusting down of long-term interest rates, which has really led the growth complex to do so well, technology to do so well. And it's very important when you study business cycles, those sectors and leaders in one business cycle typically aren't the sectors and leaders in the next cycle. And right now, the technology performance, I would say, is probably a bit excessive relative to some historical benchmark, which means that going forward, you probably want to find maybe industries, maybe older industries, less glamorous industries that might do very well because from an evaluation perspective, they're attractive.
Great. Well, thank you so much, Joe, for sharing your wonderful wisdom with us today. We really appreciate you taking the time. And thank you to our audience for joining us during this session. So have a wonderful weekend, Joe, and look forward to talking to you soon.
You as well. Thank you for your questions. And it was a lot of fun. Have a great weekend, everybody. Thank you.
Thank you.